Good afternoon, everyone, or good morning. It depends how you see the midday. Welcome to today's webinar, where we proudly present you the paper, Impact Investing, Does It Exist? Why it is so difficult to assess the impact investing market. My name is Nicoletta Centofanti, and I'm the CEO of the Luxembourg Sustainable Finance Initiative, the LSFI. For those who are less familiar with us, we are the Luxembourg Coordinating Body for Sustainable Finance, established in 2020 as a public-private partnership. Our mission is straightforward, to accelerate the transition of the financial sector towards sustainability, to build knowledge and expertise across our ecosystem, and to measure and communicate real progress. The last word, measure, is exactly why we are here today. When I joined the LSFI, I was convinced that impact investing is not simply one strand of sustainable finance. It is in many ways what should be its ultimate goal. The point at which capital is deployed with the deliberate intention of generating measurable positive outcomes for people and the planet, alongside financial returns. That conviction has only grown stronger, but it is true that to achieve this, much still needs to happen. That's why in 2024, we took a major step by establishing our Impact Investing Advisory Board, the IIAB. The IIAB brings together experts and leaders in impact investing, market builders, fund managers, NGOs, and development finance experts, among others, who collectively form the key advisory body guiding LSFI work in this space. The IIAB operates with a clear threefold purpose: to deepen the understanding of impact investing across Luxembourg financial sector, to accelerate the flow of capital towards investment that generates genuine, measurable impact, and to support the development of Luxembourg impact finance ecosystem and its strategic leadership in impact finance. At the end of 2024, we were honored to be appointed Luxembourg National Partner of the GSG Impact Network, integrating Luxembourg into a truly global community of countries advancing impact-driven finance. All of this work, however, rests on a critical foundation: data. Because without reliable, consistent, and comparable data, impact investing risks becoming an inspirational concept that does not deliver the expected outcomes. As we know, you cannot measure what you cannot, so you cannot manage what you cannot measure, and you cannot scale what you cannot demonstrate. And this finally brings me to the paper we are proudly presenting today. As I said, the title is Impact Investing, Does It Exist? Why it is so difficult in the impact investing market. As I said, I'm really very proud of this work. And as you will see very soon, we examine the state of impact investing data, the gaps, the challenges, the emerging standards, and the opportunities, with a strong rigor and a practicality angle. But now it's really time to introduce the two people who have worked really hard on this paper and who will walk you through it and discuss its findings. Caspar van Sleben and Suvi Sari. Caspar is a member of the IIAB. As Director of Finance and Operations at CAMPCO, he brings a remarkable depth of experience to this topic. His career spans microfinance, development finance, investment fund management, and academic teaching. When Caspar speaks about the relationship between capital and impact, it comes from decades of hands-on engagement with exactly that question. Suvi is the head of sustainable finance at the LSFI. She joins us from Nordea Asset Management, where she worked at the heart of ESG integration within investment strategies and led ESG communications reporting at senior level. She brings both technical precision and strategic clarity to our work, and she has been instrumental in shaping this paper. Together, Caspar and Suvi make a very knowledgeable team, and I'm sure and I know you are in very excellent hands. I hope you find this paper as interesting and insightful as I have, and be mindful that the paper will be available to you in your mailbox at 2 o'clock today. So having registered to the webinar, the paper will be directly sent to you as well. But of course, we warmly welcome your feedback and questions. Do not hesitate to share them at the email box iab@lsfi.lu. Thank you once again for being with us. And now over to you, Caspar and Suvi.
Thank you, Nicoletta, and very excited to be here today because it's been a long journey to get here. I think we worked on this paper for more than a year. I think to be more precise, it's been more like 1.5 years. And here it is. You can't see the title very well, but at 2 o'clock you can read it and see the details of what we've tried to do. On that journey, many participants were there, and they all deserve a thank you. Nicoletta contributed greatly. Suvi is here and has very greatly contributed. Alex Potter was an early contributor and should probably also deserve the thank you for what has been achieved here. So before we start to go into the paper and what it says, maybe a little bit on thought on why we picked up this topic in the Impact Investing Advisory Board. And within the board, my responsibility is on data. So when we think about impact investing and its evolution, it is in a way very strange that as the body who thinks about impact investing in Luxembourg and where it is going and what is happening, we have extremely little data. The LSFI always does a flagship event once per year where they publish the sustainable finance annual report where you can see this is what happened in sustainable finance, this is how much it grew, and this is the different categories of sustainable finance. And, you know, the private assets actually grew more than the public assets, and why is that? And, you know, it triggers a debate. We don't have that in impact investing. We don't have that sort of basis to shape a market, to give it contour, and to have a higher level discussion about what is happening and where we are heading. And in our discussion in the Impact Investing Advisory Board, I think we acknowledge that this is a problem. I mean, this is a problem when we speak to investors, this is a problem when we speak to regulators, this is a problem when we try to influence policy. If we don't even know how big or small we are and what our dynamics are, so how are we going to really position this market? And I'm exaggerating a bit here. Of course, there is some data out there. The Global Impact Investing Network, the GIN publishes data, Tameo data, others publish data. So it's not that there is nothing out there. But if you really look closely, and this is what this paper does, there's actually surprisingly little out there. And so when we had this debate, then we said, okay, why don't we start discussing this? Why don't we start to pick up this question of why is there not clearer contours to this market? Why is there not more data available? Why is it so hard, you know, to measure the size, basic figures, AUM of this sector, you know, really basic stuff? Why is it so hard to put that together? And that's really what this paper deals with. And we hope it will really stimulate the debate, and hopefully beyond the debate, some actions. We're going to come back to that, but we're actually hopeful that a number of things are happening. So this has been a lengthy introduction of why are we doing this, or why we have been doing this, and why this is probably not an end point, but maybe in many ways a starting point to a conversation. So this was a long introduction, and I promised to be short. So because I've contributed the paper, but I'm not the driving force of writing it. And luckily we have Suvi here, who is really the driving force behind this paper. And maybe to start off, it would be really good, Suvi, if you could talk us through the methodology, the scope of the paper, and explain the main pillars of the analysis. So to get us really a bit into what has been done.
Absolutely. Thank you, Kaspar, and good afternoon, everyone. Very happy to give a quick walkthrough of what we've done, how we structured the work, what the paper kind of covers. So to get started with this paper, basically, it's built on two separate, but also very much connected pillars, very naturally. The first pillar of this paper is focusing on the data provider assessment. And here we started by mapping the existing landscape of all the data providers out there that offer different types, different levels of ESG, sustainability, and or impact related data. So this means, of course, as well that the paper then looks at quite a wide spectrum of ESG, sustainability, impact data providers. And it really covers it from the mainstream ESG data aggregators to specialized impact data providers, and it even covers some of the more specific or asset class specific platforms. So it's quite a wide spectrum, and in total we assessed 33 data providers for this paper. We evaluated them against a set of criteria that we consistently used across all of these data providers, looking at what type of data they provide, the coverage that they provide in terms of which asset classes are covered by this data set. But also we looked at the granularity, transparency of the data. And of course, since we're talking about impact data, we looked at their alignment with these core principles of impact investing, those being the traditional intentionality, measurability, and additionality. In terms of the scope, we focused with this paper on the data for green, social, sustainable, and sustainability-linked bonds, so the GSSS bonds, as well as impact funds, both public and private market funds. And we made a conscious decision to exclude some of the more, let's say, complex segments, such as the credit markets and the insurance side, which were even harder to access from the data standpoint. So because of that, and also because this kind of more narrowed scope then allowed us to keep our analysis more focused, and obviously then the outcomes also more actionable for the IIAB. So that was the first pillar. Then if we look at the second pillar of this paper, that focuses more on this cross-country benchmarking. So looking at our peer countries, how have they measured their impact market? So we look at countries like Belgium, France, Netherlands, Switzerland, UK, Japan. All of these 6 countries, like us in Luxembourg, they are part of the GSE Impact Network. So that's why they're also good peers for us to look at. We went on, examined the different methodologies that they used in their own market sizing studies and exercises. We looked at how they defined impact investing in their exercise, what data did they use, and also, of course, then naturally, what were the market estimates that they arrived at. So looking at all of this across these different countries, that allowed us to then better understand whether we in Luxembourg are alone with our challenges, whether these challenges are unique here for measuring the impact market size, or whether those same challenges are kind of part of a broader pattern out there. So together, these 2 pillars, so the data provider assessment and the cross-country benchmarking, these 2 gave us kind of a clear diagnostic picture of the market out there. And in a nutshell, we saw a rich but very also fragmented data environment at the same time, and also a field that is still somewhat working towards this kind of methodological consensus and alignment. So that's in a nutshell what this paper covers and what it includes.
Thank you, Subi. And as the audience can hear, it covers a lot. I mean, we went really to the sort of foundational level, covering I think pretty much everybody who deals with this kind of data and looking at how do they do this. And then also looking at, given that this is a complex problem, what do the others do? You know, the usual Luxembourgish reaction, what happens in my neighboring countries and further away to deal with complex issues such as this. So exhaustive work, lot of analysis. What's happening? What's the takeaways? What does it tell us if we look at those two pillars?
Yeah, well, actually, I have quite a few things to highlight, but there's more in the paper, so please go and read that afterwards and determine what are the highlights for you. But for me, the highlights, I could maybe categorize them according to these two pillars that I just mentioned. So if I first look at the data provider assessment that we did, there the headline finding is that there's actually no single provider that can currently give you comprehensive, standardized, and impact-aligned picture of the market that could also be then applied across all the asset classes. So there is a lot of data out there, like you said, Kaspar, there's a lot of out there, we know that, but it is still somewhat dispersed when it comes to especially these impact-specific data sets. So many, of course, offer, many of these data providers that we looked at, they offer very sophisticated, very rich ESG data sets, such as the ESG ratings, the controversy screening, SFTR data, SDG alignment, etc., etc. So there's a lot there. And these are, of course, very valuable tools, very widely used tools among investors. But these alone, they don't really capture the concrete real world impact outcomes and the intentionality behind them that we wanted to see. So that brings me to the kind of core issue that we, in this paper, we call it the kind of shades of green do not equal impact. And what we mean by that, being green, having high ESG rating, being Article 9, or even doing development financing, those things don't necessarily automatically mean that you're an impact investor. We all know that. And I would go as far as to say that I'm not sure that even showing the concrete impact outcomes, measuring those properly yet qualifies you as an impact investor. Because like we've been discussing, I of course believe that all investments at some level, they have some sort of impact, whether it's positive or negative. And today, those impacts can also be measured quite well and across asset classes. But what the data usually does not tell us is whether these impacts were actually achieved through an intentional action. So intention being, of course, one of the key factors of impact investing, one of those three pillars that I mentioned, that distinction matters enormously. And it's one of the kind of questions that I feel like the landscape hasn't really fully caught up with yet. So that's just something that we've noticed when we did this assessment. Another challenge we found, as I already hinted towards, is the significant fragmentation between the asset classes. So if we look at the asset classes that we were covering, we found that the listed assets, those are very well covered by all sorts of ESG data providers, but more rarely they are looked through kind of a genuine impact lens, if you will. But that's then the opposite in the private market assets, where they are better captured by all of these kind of dedicated impact data platforms. But they're also, the methodologies do still vary quite a lot. So there's some alignment to be done there. Then finally, if we look at the GSSS bonds, I would say those sit somewhere in between. There's a very good data for bonds. There's very good pre and there's good post-issuance level data. And if we, for example, look at the Luxembourg Green Exchange platform, it's very visibly, transparently out there. But what the problem there is then is the kind of direct attribution to the Luxembourg domiciled investors. This is something we cannot yet assess and measure properly. So there's these different challenges in different asset classes as well. those were the main challenges, but I also just want to quickly mention, since the paper covers quite a lot of topics, some of the interesting points that also stood out in this data provider assessment is that the cost and the complexity of collecting and monitoring this impact data, and the fact that a lot of the providers also rely on self-reported data. So that can be a bit problematic sometimes. Then finally, I would highlight the very often used risk of double counting. And what we mean by double counting in this context is that double counting the impact outcomes between investors, but also double counting the impact flows then across borders. So these are just some nuances that we need to also navigate. Those were my main challenges I wanted to highlight from the paper, but I also want to end up with a kind of positive note for the data assessment. So when we talk to a lot of these data providers, we saw that they have very robust and transparent methodologies, and some of them are already very transparent, but very willing to also advocate for more transparency even across the market. So that was a positive thing, and there's really an appetite among them to work with the market for harmonizing the data and the methodologies being used. So I would say that the direction of travel at the end is positive, if we are not even there yet, but it's positive direction at least. But then finally, I'll wrap up with briefly in a nutshell what we saw in the cross-country benchmarking from that aspect. The key message there is that Luxembourg is really not alone in this challenge of how to reliably measure the size of our impact investing market here. These peer countries that we looked at, they also face these kind of same questions, these same challenges in the definitional and methodological fragmentation, also across the markets as well. A lot of them, or many of them, do rely on these self-declared surveys, which are absolutely super good for ecosystem mapping and understanding what's happening in your market. But of course, there's a kind of natural limitation in the precision and a kind of trade away there. Yeah, basically the message there is that there's not really a common standard for the sizing methodology. All of them are doing a little bit different, using a little bit different methodologies, different data, different scope. So therefore, the kind of proper cross-country comparison remained very difficult, even for us to do for this paper. So that's just the takeaway there. Of course, what we see when we analyze these countries is that there's very useful and wide spectrum of approaches. And in Luxembourg, we can, of course, take this inspiration from these studies. But I just want to remind that we need to keep in mind here in Luxembourg that the kind of cross-border nature we have here, that just adds another layer of complexity on top of all of this, all of these questions that we anyway have, because in Luxembourg, many of the funds are domiciled here, but at the end of the day, they're actually managed elsewhere and even invested globally. So we really need to navigate here constantly the question of whether the capital is where it's managed, versus where it's actually creating this impact. So I feel like that's kind of a unique challenge, and not the other countries have to face it in the same way. So my main highlights, but please do read it yourself and let us know what are your key takeaways.
Thanks, Subi. And I think there is a lot in there, what you just presented, and really invite everyone on the call to look at the paper and really look at those details. I think it's worth it. This shades of green does not equal impact, particularly stuck with me because it sort of illustrates one of the fundamental challenge we have. The IIAB has defined impact ourselves. We have an impact investing definition, so we know how we would like to draw the contours of what impact investing is and what it is not. Yet, when you look at this definition, and I think it's true for the European definitions and other definitions, it's almost always a process-driven definition. And it's maybe inherent that this process-driven approach is hard to measure for an external data provider, because how do you externally assess a process somebody does internally and whether they do it seriously or not? And I think that is a big friction point, and where, you know, these ESG scorings at a level of a portfolio, underlying portfolio, and then that ESG score is sort of moved up to a fund level, that doesn't really work for impact, no? And yeah, I think that's a very important finding. But there are other findings, so let's maybe dig into this a bit more. And we always have this debate, because I'm really in the private asset world, and Subi comes from the listed asset world. And again, impact investing is a bit different in those worlds. And so maybe one question would be, you know, how to demonstrate impact in a listed equities world, let's say, where, you know, everything you do is secondary buying, and, you know, how does it generate any impact to start with, no? Sort of very ignorant question from the one sitting on the private asset side. And then we also have this distinction between what's happening on the investor level, the fund level, or the bond level, and the investee level, no? Which are different impact levels, and how does it influence the way we would look at the sector? So what's your take on those?
Yeah, exactly like you said. So I think we're now moving away from the kind of analytical part of the paper to the more kind of philosophically interesting part of it. And these things that you highlighted, I think they are quite well known, but I think it's also a useful reminder to all of us and to myself, and it's something that we maybe forget sometimes in these conversations. So in this paper, we do make the distinction, like you said, between the two types of impact. So there's obviously impact that is generated by the investee company. So that happens through their products, their services, and their or their operations. And then there's the impact that is generated by the investors themselves through their role as a capital allocator, of course. So this investee company impact, that at least to some degree can be quantified across asset classes already today. And like I said before, I think we can really argue that all investees will always have some sort of impact, whether it's positive or negative. But measuring the investor impact, and especially demonstrating the intentionality and additionality, that's a much harder thing to do in general, but especially we find that it's hard to do in the listed equity space. And why is that? Is of course because in the listed equity markets, you're typically naturally trading securities in secondary markets. So kind of making the classic impact justification that they intentionally finance certain impact outcomes or impact projects or certain kind of company transformation, and that the impact would not have happened without that financing that they provide. This case is much harder to make in that space. And that comes then back to what we also highlight in the paper as the kind of increased importance of active ownership and stewardship, especially in this listed impact investing space. But here too, as well, even if we use active ownership and stewardship as a tool to kind of enforce the narrative of impact investing, the data and the measurement of these active ownership outcomes, that's also still a challenge. So if an investee company changes its behavior following an engagement or a voting of multiple shareholders, who is really there to claim rightfully that outcome as their own impact? So while this active ownership is absolutely clearly a great tool for listed equity investors, especially to enforce the kind of impact narrative they have, there are still some of these challenges that remain, how to correctly measure it, how to correctly allocate that outcome as well. On the other hand, also related to this active ownership topic that we're talking about, there are quite a few now listed equity funds where the active ownership is kind of at the core of the investment strategy and key part of of kind of dictating how the investment decisions are made. Yet those equity funds, they are not necessarily named or even considered as impact funds. But with that kind of intentionality and additionality, where you intentionally want to invest into a company, to engage with it and to change something, and you manage to do that, I mean, couldn't one argue that that would also fall within the kind of wider spirit of impact investing? So this is just what we wanted to highlight in this paper, to kind of invite this conversation and discussion on these topics and raise these more philosophical questions about what really is the scope of impact investing, and kind of highlight the need for additional clarity perhaps, and also a common alignment in the industry. Of course, I mean, alignment with the industry, I think we've seen, of course, the regulatory environment developing and guiding the industry a little bit. So we've seen the ESMA naming guidelines for impact named funds, and more recently, we've seen the proposal for SFDR 2.0, those changes that kind of introduce an impact category separately. So these kind of regulatory changes, of course, also help us to align this kind of impact conversation. But I think that the industry also needs to come together and align and discuss these topics. So yeah, like you said, Kaspar, these are some of the more philosophical nuances that we also explore in this paper. So please go check it out. I would be very interested in knowing what your thoughts are, whether you agree with them, whether you want to raise some other points. That's really what the paper is trying to achieve, the kind of discussion happening in the industry. But yeah, so we are not ending here, of course. So instead, I'd like to, now that I've been talking a lot, I'd like to turn the tables a little bit and tap into Kaspar's very extensive knowledge and the many hats that Kaspar wears in this impact finance space. So Kaspar, my question to you, what does the IIAB make out of these findings that we present in the paper? And also I'd like to hear, how do you personally see these findings? How does that reflect with your own experience working many years in the field of impact investing?
Yeah, thanks, Subi. I mean, the title we have to the paper is a bit provocative. No, impact investing, does it really exist? Does it exist? So we are the Impact Investing Advisory Board. So is the work we're doing worthwhile doing? As sort of, I mean, there is an intentional provocation in framing it this way, but also because we like to point at this as a real issue. And I think it's an issue which transcends all the individual assets, actors. And so really as something where we need to come together, not only at Luxembourg level, but also collaborate with, neighboring countries, other bodies, the GSG global network, to really advance this debate. And on the GSG global level, data is one of the big priorities. So the IIAB is not going to say, well, tough findings in the paper, let's go home and look at it again in a year. So what we are doing in parallel is, again, a lot of groundwork. There is an ongoing stakeholder mapping for Luxembourg, which hopefully will produce a clearer landscape of who is engaged in impact investing in Luxembourg. What do they do exactly? Can we put some numbers around this? Can we sort of try to ourselves to create a bit of this contour? If some of you have been contacted in this exercise, thank you very much if you've contributed. If you are yet to contribute, please do so, because I think it's an important exercise to, in the absence of sort of this solidified sector contours, we're sort of trying to create a process to get there. And encouragingly, in parallel, something quite similar, I think, is happening on the European level, where Impact Europe is basically engaged in a European mapping exercise to try to define the contours of the market. And so I think both of these sort of come together at an interesting time where, as Subi is saying, there's also need for maybe as a sector to find your voice. For example, do we agree in the way that the latest SFDR proposal has framed certain aspects of impact investing? Do we disagree? If yes or no, how do we voice this and sort of collectively? So how do we create this collective momentum behind a group of actors which sort of coalesces around this impact idea? So this is a bit what's happening, and I think it's an important process, particularly challenging. And so we highlighted that again in Luxembourg, where actors are in Luxembourg and they're not in Luxembourg. So there may be an asset manager based in Switzerland, which has some presence here, or in the Netherlands, etc. So you need to sort of also navigate this unique role of Luxembourg has in an investing ecosystem where you're sort of part of a larger machine. You know, some wheels are turning in Luxembourg and some are not, and this creates this sort of challenge also when you look at data. So we mentioned double counting. So the IIAB is working on that, and we'll continue to work on that. Again, we invite all of you to participate if you have things to add. We are here to be approachable and federate these efforts. There is going to be an event sometime soon, which I'm sure, so we can maybe fill in on dates and details.
Yes, 8th of July, we have a meeting where we will present a little bit of the mapping of the ecosystem. So keep an eye on that. That would be interesting.
Yeah. And maybe to close this webinar, we are almost out of time. And maybe to take a bit this negative connotation away. We have data points which tell us impact investing matters in Luxembourg. We know that about 27% of global impact AUM should be in Luxembourg. That should make it a quite meaningful, sizable sector here, and one which can and should claim its space in all the different debates, industry debates, regulatory debates, policy debates. And so that's a bit what drives us, in this work, that we come up with these data points, come up with this framing to really assert impact investing. I think at a point of time when we are at a moment of consolidation in our markets, of maybe after many years of expansion, of maybe more reflection, but also maybe becoming a more professional and better organized sector. And I think this is one small piece in this overall puzzle. And that's why we are quite proud to participate in that. So that's the motivations. Again, paper will be out there. The debate will continue. As I said, this is the starting point. It's not the end point. And hopefully we're going to be sitting here in 2 years and having a different discussion with more data at the table. Thanks again to the entire LSFI team for putting not only this webinar together, but putting the entire support work for the IIAB together. Thank you, Subi, for all you've done here. Thank you, Nicoletta, for hosting and continue supporting the IIAB. And thank you all for listening and being interested in this topic.